In this episode of the Retirement Planners of America podcast, we want to show you why buy and hold could be a disaster for your retirement. So stay tuned. We're going to get right to it.
Retirement Planners of America, RPOA.com.
Hello, RPOA Nation, and welcome back to another episode of the Retirement Planners of America podcast. And in this episode, we want to talk about the buy-hold disaster, as we call it, meaning that if the only thing you do is you buy high-quality investments and you hold them forever through thick and thin, that could be a disaster for your retirement. And so we want to show you very specifically a period between Y2K and 2015. Now, I know what you're thinking. That was 100 years ago, and that will never happen again. Well, let me tell you, folks, if you don't learn from history, you're doomed to repeat it. And so learning from history, I think, can be very helpful. So, Jeremy, we're going to show very graphically, and I think in very dramatic fashion, what could happen to you if you decide that buy and hold is the only thing you're going to do.
Absolutely. And I think before we go any further, I am going to be the Debbie Downer here and read something that's compliance asks us.
Compliance again.
I know. The cursed compliance.
All right.
Past performance is no guarantee of future results. Each person is different. Therefore, there isn't a combination that suits everyone. Diversification is not a strategy without risk. The data in this podcast will reflect our opinion.
Yes, it does reflect our opinion, but it should be everybody's opinion,
right.
in my opinion.
Right. the right opinion, right?
And that is my opinion, by the way. So,
right.
Man, that was boring. You realize half the people tuned out. We lost our entire audience right there.
I tried to hook them in and then just bore them to death.
Man, okay. All right. Well, we got that over with, so let's dive in. So, one of the things that we always talk about is we call it a buy-hold myth.
Right.
And buy-hold, we believe, as I said, it could be disastrous. And I'm going to show you very vividly here in a minute why we think that. But, buy and hold is the myth is that, the market will always come back.
Always comes back, right?
Always comes back.
Right.
And, that may be true because as we look back in history, the market has always come back.
Right.
So the first thing I would say is, does that guarantee you that it will always come back?
Right.
Okay. And the answer to that is no. Okay. And secondly, the question would be, okay, it may come back, but how long is it going to take to come back? There's an old expression that says that the market can stay irrational longer than you can stay solvent.
Absolutely.
So you may be sitting there holding on and thinking, man, this market's crazy. Why is it still going down? Doesn't it know that the fundamentals say it should be going up? And meanwhile, you're going broke.
Yeah.
But the worst part of it is that, yes, the market may come back, but if you are taking money out as your investments are falling, you're doing what farmers call eating your seed corn.
Yeah.
And the problem with that is that if you eat enough of your seed corn, then yes, growth season may come back, but you may have eaten so much of your seed corn at that point that you ain't got nothing left to plant.
Right.
And that would be disastrous.
Right. Buy and hold to me feels like a young man's game or a young person's game, I should say. Yes, you can maybe get away with buy and hold in your 20s and your 30s, maybe even in your 40s.
Yeah.
But as you start approaching that point where you're not putting money back in and you're getting to the point where you're going to start removing your seed corn from that it becomes super important to take a different look, a different strategy. There's always a different strategy for everyone, but that differing strategy needs to change dramatically as you get closer to that retirement age.
Man, that is so well put. I think I can retire and let you do this for me. That was awesome.
Thank you.
Yeah, no, that's exactly right. And the most important decade of your financial life, as we see it, is the 5 years before you retire and the 5 years after you retire. Mm-hmm. That decade, we think, is super important to protect your principal. And so as you get closer to that time, you need to start thinking about how to protect that. But what we're going to talk about here is once you are in that first 5 years, maybe that first 10 or 15 or 20 years of your retirement,
Right.
you're taking money out to live on, okay? And the market is doing what it's doing. And if you're a buy holder, I think you're actually a buy, hope, and prayer.
Yeah, right.
And we believe that that's not a good financial plan. It's a hope and a prayer.
Yeah.
So I want to go back to the year 2000, and so let me show you this. Now, again, a lot of you are thinking 2000 was like, 100 years ago. It'll never happen again. Don't even think about it. Well, let me tell you, folks, if you don't, as I said, if you don't learn from history, then you're doomed to repeat it. And, the whole notion about the market coming back, if you look at Japan, for example, they peaked in 1989, their stock market did. And here we are, however many years later that is, and they still haven't gotten back. So if you were a Japanese investor and you thought that buy and hold was the thing you ought to do, and you were now living on that money and you're taking money out, it actually has never come back. And I would argue that you probably run out of money a few years ago at this point. So yes, the market has always come back, but counting on that, we think, is not a good idea. So this period here I'm going to show you is the period from 2000 to 2015. And so let me go over with you the assumptions we're going to make. So first of all, $1 million, Jeremy, is my favorite number.
Yes.
Okay, $1 million, okay? As was it Austin Powers once said. So $1 million is the amount you're going to invest, okay? So that's a nice number. And we're going to assume that you're going to take out 4% each year.
Okay.
Your annual withdrawal rate is going to be 4%. And that's because historically people have said that if you take out 4%, that your money will last the rest of your life.
Okay.
And I'm going to show you here how, and supposedly 4% is a conservative amount to take out, et cetera, et cetera. And I'm going to show you how it could potentially lead to disaster. Now, we're also going to assume a 2% inflation rate.
Okay.
And so what that means is that the cost of living, the amount you're taking out each year, is going to go up by 2%.
Okay.
And now you may say that's pretty low. If I put in a higher number, then you run out of money faster because if inflation is going up faster than that, it means you're going to have to take out more. And if that happens, then everything I'm going to show you will actually accelerate.
Yeah.
So this is actually conservative by using 2% inflation. But be that as it may, what I want to do here is, let's say that you have your $1 million nest egg. Okay, so here's your $1 million. And now you want to take out 4%.
Yep.
All right. And if you take out 4%, that would be $40,000. Okay. All right. So that's so far so good. You had $1 million. You take out $40,000. Next thing we want to look at is, what did the stock market do in Y2K? Okay. So this is the year 2000. And before I do that, let me show you what your cost of living would do with inflation. Okay. So you started with your 40. And by going up by 2% each year, you can see what it does here. And by 2015, your cost of living now has gotten to $53,835.
Right.
So this right here is the effect of what inflation does.
Yes.
All right. So this is just at 2% inflation. So now I want to go and show you what the market did. So in 2000, the market went down 10%. So not terrible, not what you like, but not awful. And so what that translates into is $101,000 of your $1 million got lost due to the fact that the market went down that 10%. So the next thing then is, how much total did your portfolio go down, right? So you started with $1 million, you took out 40, and the market took out 101,000. So the total now that came out that year would be 141,000. So then what happens is, your nest egg was $1 million. It's now 858,000, and you took out that 4%.
Wow.
Okay. So right now you're a little concerned. You had $1 million, 858,000 is a little concerning. But let's look at what happens next. Okay, the buy and holders would tell you, don't worry about it. Hey,
it's coming back.
Market always comes back.
Yeah.
All right. So that bear market actually ended up lasting 2.5 years. So you can see here that we had a 13% loss in 2001. We had a 23%. That was the big when the teeth came out in that bear market of 23%. So if we look at what that meant, that meant that in 2001, your 858,000, losing 13%, went down by 111,000, and then the following year it went down by 164,000.
Ouch.
Ouch is right. But you got to live.
Right.
You're not going to stop living just because the market went down. You got to
still have to
spend.
eat.
You got to still eat. You got to pay for your bills.
Yeah.
So your 40,000 with inflation went up to 40,800, 41,600, and so the next thing we look at is how much total came out of your investments. Well, you took out the 40, and the market took out 111, and so the total was 152,000. And then the next year you took out 41, the market took out 164. And now you have 200,000. So where does that leave us? Well, that leaves us with, you went from 858 to 499,000. And this is, keep in mind, you've been retired 3 years now.
Oh.
Your $1 million your beautiful $1 million
Yeah.
in 3 years at the end of 2002 is down to 499,000. So Jeremy, I'm going to put you in that place. How does that feel?
Disastrous. I'm beyond panicking at this point. I'm considering going back to work.
Yeah, but you've been out of work for 3 years, right? You've been retired.
Yeah.
So
What am I going to do?
you're going to go back and compete with those the youngins? Maybe. All right, well, let's look at what happens next. Buy and holders tell you that, hey, don't worry about it, right? You're in your hammock, you're sipping your mint juleps. The market always comes back.
Right.
And sure enough, look what happened. In 2003, the market went up 26%. And then in 2004, 8.9, not a great year in 2005, but whoa, 13%, and then 3.5% in 2007. So sure enough,
Yeah.
as promised,
Absolutely.
right? It's in the brochure.
Yeah.
Market comes back.
I'm good, right?
Well, let's examine how good you are. So what happens is, look at the returns you made. Holy cow, you made 131,000, 52, 17, 77, 21. You're raking in the cash, baby.
Absolutely.
Yeah, you like that. Well, but the problem is you got to live. So that marches on. So now you spent 42, 43, 44, 45, 46,000. And so the total that came out of your account or was added is a lot smaller than maybe you thought, right? So here's you put in 89, only 9,000 that year. Oops, you turned negative in 2005, had a good year in 6, and down 24,000. So where's your nest egg now? Well, it came back a little bit. You went from 499, which we were freaking out about, and you're up
Right.
to 580.
Okay.
And you're starting to think, well, maybe, there's a light at the end of this tunnel.
Absolutely.
Well, unfortunately, the light at the end of this tunnel
Yeah.
is a train, and it's called 2008.
Yeah.
So 2008 comes along, and look what the market did in 2008. It went down 38%. 38%. And that translates into $223,000, 38% of your 580. And then the next thing that means, you got to still live, right? So you took out another 46,000, 47,000. So the total that came out now is $270,000.
Oh.
And you had 580.
Yeah.
So how much do you have now? Can you do the math real quick?
No,
All right,
no
I'll do it
chance.
for you. $309,000.
Ugh.
And you've been retired 8 years.
Yeah.
Oh, but don't worry.
It'll come back, right?
The market, exactly. The market always comes back. You don't have to worry about it. Just be patient, because it's going to come back, and you're going to be
Right.
fine. You're a long-term investor.
Right.
Right?
Yeah.
Long-term. Yeah, got to think long-term here. So now the market does come back. And in fact, from 2009 through 2014, we had a good run. It goes up 23% and all that, 29% in 2013.
That's pretty good.
Holy mackerel. We're raking in the
Yeah.
cash again. And of course, this is how much money your investments made. But guess what?
I still have to spend money, don't
You
I?
still have to spend money. You got to
yeah.
live. So now you're spending 47, 48, 50, etc. And so what's the total that happens? So even though you got these nice gains,
Right.
what happened was that only 2 of those years of the big bull market from 2009 through 2014 did you actually have a positive gain in your portfolio. You actually were shrinking the whole time. And where are you now? You're actually down to $200,000. So you started with $1 million, and 15 years later, you're down to $200,000. So again, I'm going to put you in that place, Jeremy. How are you feeling right now?
In a some world in which I would hope to be retired for 30 years. I'm halfway, and I don't think I have half of my $1 million
Right.
left.
I mean, let's say you retired when you're 60. You're 75 now. You're still a young man. You still got a lot of life ahead. But boy, your money has taken a beating. So let's look at something really interesting here. And this gets to the eating your seed corn part.
Yes.
Okay.
Right.
So we agreed that you were going to take 4% out. Right? But look what your investment has to do over here to compensate. So this $41,000 that you took out in 2002, that was 6% of your money.
Wow.
I thought 4 was where I wanted to be. 6%, okay, I can live with that. But look what happens. It goes up to 9. It goes up to 15%. And then it gets up to 18%. And right now in 2015, it was 20%. So if you look forward, what does this mean? It means that now your investments, starting in 2015, need to make 20% every year from now on to compensate for all this.
Wow.
Now, how are you going to do that? I mean, I think we're good.
Yeah.
Okay.
Yeah.
But we don't go promising people they're going to make 20% every year for the rest of their lives.
To tread water.
To tread water.
Yeah.
Okay. That's a tough road to hoe. So this is what it looks like. This is the chart. Okay. So you started here with $1 million.
Yep.
And then look at that. Boom. You bounced off the $499,000 in 2003. The bull market came till 2008. And you actually got back all the way to 600,000.
Hey.
You're headed back to that $1 million. You're still not there yet.
Yeah.
And then boom, 2008 comes along. You're down to 300, and then you can't support it. So what do you do with this?
Right.
How do you deal with this? Well, I remember I went to MBA school. I went to SMU for my MBA, and we had a guest visitor to one of our classes. And he was a billionaire at that time.
Okay.
Which, by the way, this was like, 2 centuries ago when I was at SMU. So it's when $1 billion was a lot of money.
Yeah.
And he had started. He's a serial entrepreneur.
Okay.
And he's talking to this class of super smart MBA students. And he said, and he started, I think, like 40 companies successfully. So that's what he loved. Starting and getting them up there, but he didn't like managing them after that. But he asked his whole class of really smart MBAs. He said, "Okay, so let's say that you have your business, and your biggest customer, who represents 40% of your revenue, walks in the door and says, 'I'm moving my business to a competitor.' So, class, what do you do?" So the class was like, "Oh, gosh, okay. So what we do is we get our salespeople out there and we start shaking the bushes and we need to get some new business." And he goes, "Wrong." Okay. So we get our marketing team out. "Man, we got to start advertising. We got to start getting new business in the door." "Wrong." And so everybody's like, "Okay, we don't know what to do."
Yeah.
This is smart MBA students, right? We're supposed to be the next generation. And he goes, "You got to cut expenses by 40%.
Yeah.
You got to survive this first, okay? You are hemorrhaging now, and you got to stop the bleeding right now." So what does that have to do with this story? Well, you can see what happened, right? You lost 50% of your money in 4 years.
Yep.
So now what do you have to do if you want your money to last as long as you do?
Change your lifestyle.
You got to cut costs by 50% to make up the difference.
Yeah.
Because as I showed in that chart, you're now taking out 8, 10, 15%, and you can't do that.
Right.
If you're making 6 or 7 or 8, you can't be taking out 15.
Right.
So the way to counteract that is, in our view, is you're going to have to cut your cost of living in half or 2/3.
Yeah.
And that does not sound like a fun retirement to me.
No.
So what we believe is that you should have a strategy to address that. You should have a strategy to protect against, these big bad bears. And, again, you may be saying, "Okay, well, that was 2008. That was Y2K. Those were historic bear markets, and that'll not happen to me, or it won't happen again." Well, the people that lived, through the 70s and the 80s and the 40s and the 30s and the 60s, they all probably said the same thing. Oh, well, this was the oil embargo. It was a historic bear market. We'll never get that again. And then 80s come along with hyperinflation.
Yeah.
Well, we'll never have hyperinflation
Yeah.
like that again. And boom, they got hit by hyperinflation, and they got hit by the 70s. And then the 80s. So if you think that this won't happen again,
Right.
you're putting your head in the sand. And,
Yeah.
and we're planners, right? We plan for the worst and we hope for the best.
Of course.
Because our view is we want your money to last as long as you do. And in our view, the only way we can do that is by not only diversifying, not only rebalancing, not only making sure your cost of living doesn't get out of whack with what your investments can support, but also addressing the single worst enemy you have to your financial well-being, in our view, which is bear markets.
Yeah.
And for that, we have a strategy in our firm we call Invest and Protect. And for those of you who have not seen watched our video podcast on that, I encourage you to go find it and watch that, where we talk about building a strategy into your retirement plan to protect against big bad bears.
Yeah.
Because if you're going to be retired, hopefully you retire 60, 65, with technology today and everything that's happening, it's possible you could live to be 100.
For sure.
So you could live more years in retirement than the actual years that you work to accumulate the money you're now going to retire on. Think about that.
Yeah.
And so, if you don't have a strategy to address a big bad bear, and I'll ask you, ladies and gentlemen, what do you give the odds of between now and the rest of your life that there's going to be another big bad bear market?
Yeah.
What odds would you give it, Jim?
I would say probably a 100% chance that is going to happen.
I would say the same thing.
Yeah.
I would say that over the next 20 or 30 years, the likelihood of another big bad bear or two or three is very likely.
Yeah.
And so then the next question that begs is, okay, if you think that, then doesn't it make sense to build in a strategy to address what you think is going to happen?
Of course.
It's kind of like, our headquarters are in Texas, and so down on the coastline, hurricanes happen, right? So not preparing for hurricanes would be foolish, right?
Right.
So you build a plan to address it, and you hope that hurricane isn't going to hit you. You hope that we don't have any hurricanes. You hope that if it does happen, it's not super destructive. You hope for all those things. But you plan for the one that's the really big bad one.
Yeah.
And if you're going to be okay, or you've built enough of a defense that it doesn't destroy you, then that should give you some peace of mind, right? And it should also help you to survive it if it happens.
Yes.
So that's the same thing with your investments. We believe that.
Yeah. Yeah, there's every single one of those examples that you've given, they're all anomalies. They're all, that's just happened one time. That'll never happen again. Well, it's never that. Usually, it's not the same thing happening over and over again. It's a lot of anomalies. And so if you see a pattern of anomalies happening on a consistent basis, you can reliably predict another anomaly of some kind is going to come around again.
Yes, that's brilliant. Yeah, and in fact, if you look back at the Y2K, that was the dot-coms.
Yep.
Okay, and then 2008 was the credit crisis with all the subprimes. So they're completely unrelated, although I believe they were both created by the Fed and other things that they did. But be that as it may, the Great Depression, the oil embargo in the 70s, the stock market crash in 87. To this day, nobody actually knows why that happened.
Right.
That was just a mass global panic where people just freaked out and the market, they just sold off. And nobody knows why that happened. The economy was not in bad shape. There was no thing you can point to that says that's the reason, other than the herd mentality.
Yes.
It just started and it just kept on going, and it was horrible.
Somebody yelled fire and everyone panicked.
Everybody
there was
panicked.
no smoke.
And there was no smoke. That's well said.
Yeah.
So you're right. What's going to cause the next one? I have no idea.
Yep.
But do I think there will be another one? Absolutely. Yep. And do I think I should plan ahead for our client base and our squippers? Should we do that? Absolutely.
Yeah.
Because if we don't, I believe we're not, I don't believe we're being responsible with the duty we have to our squippers and our clients.
Well put.
So, ladies and gentlemen, We call that the chart that you were looking at a minute ago, the buy-hold disaster. As you can tell, we think that buy and hold is an incomplete strategy. We believe that you should buy, yes, buy quality investments, diversify, and rebalance your portfolio on a periodic basis, but we don't think it's enough. We think it's 2 legs of a 3-legged stool. The third leg is the sell part. Okay, so if you have a 2-legged stool, it's not going to be very stable, right? And you don't want unstable stool. Okay, that's really bad.
I'll leave that one. I won't even remark.
Yeah, you want solid stools, and so therefore you want that third leg of your stool, so it can keep the your stool steady, and you don't fall over. So have a strategy to address bear markets. We think that's important. So a couple things here. Make sure you like and subscribe this video. It'll help us out tremendously, and you'll get it. If you're subscribed, you'll never miss one at this podcast. And then also make sure you go to our website, rpoa.com. And you subscribe to our Market Alert video. This is our weekly video that we send out. And in that one, we actually told everybody in November of 2007 to sell, to get out, to protect yourself against what came next, which was the credit crisis of 2008, which we talked about. Our strategy said to sell the day before the pandemic happened. And you know what happened with the market after that. So we have a strategy to address it, invest and protect. And in the Market Alert videos, we also tell you what we think and where we're going from here. So thank you for watching. I hope this and listening. I hope this video finds you healthy, wealthy, and wise. And we'll talk soon.
Retirement Planners of America.